Good day and welcome to Suryoday Small Finance Bank Limited Q3 9M FY26 earnings conference call hosted by Arihant Capital Market Limited. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference has been recorded. I now hand over the conference to Ms. Juhi from Arihant Capital Market Limited. Thank you, and over to you, ma'am.
Hello, and good morning to everyone. On behalf of Arihant Capital Market, I thank you all for joining into Q3 and 9-month financial year 2026 earnings conference call of Suryoday Small Finance Bank Limited. Today, from the management, we have Mr. Bhaskar Babu Ramchandran, MD and CEO, Mr. Hemant Shah, Executive Director, Mr. Kailash Chaudhary, Chief Financial Officer, Mr. Himadri Das, Investor Relations Head. So without any further delay, I will hand over the call to the management for me. Over to you.
Thank you, Julie. Good morning, everyone, and thank you for joining us for the Suryoday Small Finance Bank Limited's Q3 and 9-month FY26 earnings conference call. On behalf of the entire Suryoday team, I wish you a happy Basant Panchami. We are happy to know that we are stepping into our 10th year of our journey. Taking you through the bank's performance for Q3 and 9-month FY26. As of December 31st, 2025, our gross advances stood at Rs 11,885 crores, registering a healthy year-on-year growth of 24.3%. compared to Rs 9,563 crores last year. Disbursements excluding supply chain finance during the 9 months ended December 2025 were Rs 6,230 crores, up 30.2% from Rs 4,785 crores in the same period last year. While the broader microfinance industry continues to navigate through a phase of tighter underwriting and asset quality normalization, we are seeing visible signs of stabilization and growth. Growth momentum remained healthy across key segments, particularly in inclusive finance, wheels, mortgages, digital deposits, and credit on UPI. On the inclusive finance side, disbursements have largely returned to earlier run rates, with the business now clocking closer to Rs 500 crores per month. Collection efficiency continues to improve, with the current bucket for the IF portfolio inching towards 99.5%. As highlighted earlier, our strategic shift from the JLG model towards individual lending continues to gain traction. Individual loans now constitute approximately 72% of the inclusive finance book, enhancing customer quality and portfolio granularity. Importantly, close to 99% of our inclusive finance portfolio remains covered under the CGFMU scheme, providing strong capital protection during periods of unforeseen industry stress. Vikas loan disbursements during 9-month FY26 stood at Rs 2,729 crores, reflecting sustained year-on-year growth. The increasing share of new-to-bank Vikas loan customer is expected to further strengthen portfolio stability and risk-adjusted returns. On the retail asset front, momentum in both the commercial vehicles and mortgage business continues. The commercial vehicle portfolio grew from Rs 1,190 crores in December 2024 to Rs 1,609 crores in December 2025, registering a year-on-year growth of 35%. While the CV segment had witnessed some stress earlier, we are now seeing clear signs of improvement in collections, asset quality trends. Our focus remains on building a granular retail franchise while also selectively scaling commercial equipment financing and used vehicle lending. The mortgage book, which includes micro mortgages, expanded from Rs 1,999 crores in December 2024 to Rs 2,778 crores as of December 2025, growing by 39% year-on-year. The strategy of focusing on select micro markets and cash flow-based underwriting continues to deliver steady and sustainable growth. In addition, our unsecured business loan portfolio is growing at a healthy and calibrated pace, which is now clocking a run rate of Rs 20 crores per month, with the portfolio crossing Rs 115 crores in the MSME portfolio, further strengthening the retail asset mix. On the liability side, our deposit base expanded to Rs 12,865 crores as of December 2025, reflecting a year-on-year growth of 32.5% from Rs 9,708 crores. Retail deposits continue to strengthen, with their share improving to 87%. Our CASA ratio stood at 21.2%, underscoring improving deposit granularity and franchise depth. Digital continues to be a key growth driver for the bank. Digitally sourced deposits now contribute nearly 30% of incremental deposit accretion and continue to gain momentum. This channel has enabled us to acquire mass affluent large pool of retail customers at a significantly lower acquisition cost and with high scalability. Asset quality trends are well within the expected rate. As of December 2025, our GNPA ratio stood at 6.6%. The CGFMU cover continues to safeguard the bank's balance sheet with a 100% claim rate on the eligible portfolios since inception. Out of an NPA of rupees 501 crores as of December 25, rupees 467 crores are receivable under the various cohorts under CGFMU scheme. Moving to financial performance, net total income for 9-month FY26 increased by 3.2% year-on-year from rupees 1,019 crores to 1,052 crores. Q3 FY26 increased by 16.2% year-on-year from rupees 308 crores to 358 crores. Net interest income decreased from rupees 862 crores to rupees 782 crores, while pre-provision operating profit decreased from rupees 343 crores to rupees 277 crores. Our cost of funds stood at 7.7% as of December 2025, same as a year earlier. The cost-to-income ratio for 9-month FY26 increased by 73.6% from 66.4% in the corresponding period last year. Profit before tax for the period stood at rupees 102.2 crores versus rupees 148.7 crores in the year last year. The bank continues to maintain strong capital adequacy ratio of 21.9%, well above the regulatory requirement of 15%, providing adequate headroom for future growth. On the digital asset side, we believe credit on UPI has the potential to be a game changer for the industry. The product allows customers to start with low credit limits and graduate over a period of time based on repayment behavior and transaction history. Our partnership with Paytm in this space has shown strong early traction, with customer onboarding growing exponentially with 2.2 lakh active customers in 1 quarter. Along with products such as secured credit cards, digital MSME loans, and digital deposits, these offerings are helping us build a fully integrated digital banking ecosystem. Our customer base expanded to nearly 3.7 million as of December 25, compared to 3.3 million a year earlier, representing close to 1% of the Indian households. Our focus remains on serving this base more deeply and meaningfully. Overall, with a largely CGFMU-covered unsecured book, a growing base of granular retail assets across CV, mortgages, and MHL, a strengthening deposit franchise, and a robust digital infrastructure anchored by products like credit on UPI and digital deposits, we believe Suryoday is firmly on the right path to building a resilient long-term institution. With improving repayment behavior, disciplined credit process, easing portfolio stress, and improvement in cost-to-income, we expect the coming quarters to mark a phase of stability and consolidation, setting the stage for healthier and more balanced growth in FY27. Thank you for your time. We'll be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir.
Yes, sir, you're audible.
Yeah, thank you very much for this opportunity, sir. So just wanted to understand first up, across the industry, we have seen in general the gross NPA declining on a quarter-on-quarter basis, but for us, it has increased, right? So what led to that, and how do we see gross NPA going forward?
Hey, hi, morning, Deepak. So one of the things that we will need to keep in mind is that our entire MFI book is covered under the credit guarantee scheme. Mm-hmm. So we don't really look forward to quarter-on-quarter write-offs. All of these will essentially get squared off at the time of us making a claim.
Okay. So basically, because of lesser write-off, it's still in the book, so it's
correct.
Going in your...
And as you would have noted that in Q2, after we got the 340-odd crores claim honored by the credit guarantee fund, we did a major write-off at that particular point in time. So our write-offs will be coterminous with the claims that get received by us.
Correct. Okay. I got it. And in terms of your PSLC, I mean, how do you see fourth quarter? I mean, PSLC. I mean, and what was your PSLC income this quarter, third quarter?
So in Q3, we made about 6 crores as against 10 crores in Q2. But this year has generally been a very rich year for the PSLC market. On an average, they were trading at around 2.65 versus 1.9% last year. So at this time, it's a little difficult to predict, what the market demand will be in Q4. But typically in the last 2 years, we have seen that there is an active market towards the end of Q4.
Correct. I mean, yeah, you have said in the past as well, I mean, for fourth quarter, generally your PSL's income would be, generally tends to be higher.
Correct.
Okay, understood. And on cost to income, I mean, you spoke about improvement in cost to income. So any sort of, benchmark we have where we want to reach in how much time? So
I think, the first port of call for us will be that in the next financial year, we are able to come well below the 65% mark because we would have by Q1, cleared up our non-paying book in the portfolio. So that's where we start the beginning of the year and then see what kind of improvements we are able to do. But the important point to note is that, insofar as our corporate costs are concerned, they have remained more or less at the same level over the last 4 quarters.
Okay. So currently, I think we are doing around 75%, right? So next year you're targeting below 65. That's a big jump, right?
Yes, I think with the increase in the paying book, a number will be under 65% would not be difficult for us to achieve.
Okay, understood. And just one last thing on FY27, any sort of guidance you can provide in terms of growth and ROAs?
Well, it's a little too early. As you can see how the market is evolving, right? But what do we see is that, especially in our MFI business, our ex-bucket collection efficiency will be back to normal, which in this industry is 99.5. So that will be a starting point for us to, building for the results of FY27.
Correct. And what's our steady state credit cost in general? I mean, now since we are going towards normalcy, right? Entire industry as such. So
I think with the kind of mix that we have today in our portfolio in the bank, we would want to have a credit cost of, not more than 1%. Okay,
so around 1%, yeah. Okay. That would be it from my side. Wish you all the best. Thank you so much.
Thank you, Deepak.
Thank you. The next question is from the line of Shailesh from Centrum Broking. Please go ahead.
Yeah, good morning. Is my voice audible?
Yes, Shailesh.
Yes, sir.
Yeah. So I have few questions. Thank you for the opportunity and congratulations on the quarter. So it is encouraging to see that we have seen good balance sheet growth this time around during the quarter. So my first question is on earnings growth. So several peers have reported strong quarter-on-quarter improvement in profitability, largely driven by asset quality and recovery in MFI disbursement, right? So could you outline when we should expect a similar earnings trajectory for Suryoday?
Yeah, I think if you look at this quarter, our portfolio grew by around 7%, which translated into an earnings growth of around 20% quarter-on-quarter. As we see it, I think starting Q1 of next year with the entire remaining bad book going out, we will naturally see an uptick in our earnings.
So not fourth quarter, but the first quarter FY27 should be the same as the quarter where there is a substantial jump in the quarter-on-quarter earnings growth.
Yeah, so Q4 will certainly be much better than Q3, even where we stand today. And that's largely because of the fact that, there has been a steady increase in my paying book. My paying book has increased by around 170-180 crores in this one quarter itself. So that trend will continue. And we see a significant increase in our paying book, especially in MFI, in Q4 as well. We have just shared under 99.5 in the ex-bucket collection, and we are very confident that we will be able to reach the 99.5 target. beginning Jan.
Yeah, so that's a good probability that the fourth quarter profitability in quarter-on-quarter basis can be very good. Okay, fair enough.
Yeah, it is significantly higher than the 36 that we have delivered.
Yeah. That is what I was trying to understand. Okay, so my second question is related to asset quality. So in line with earlier guidance, there has been a gross slippage, there has been a moderation, right, which you had guided earlier. So can you give an outlook for fourth quarter, how things are shaping up? And also in terms of JLG and individual lending state-wise performances, if you can highlight any material development during the quarter.
So I think one thing that you would have noticed is the shift that we have made from the JLG to the individual loans. Currently, if you look at the disbursements in the MFI book, about 80% is for Vikas loan. And from where we are today, we expect that our slippages will be about 100 crores and thereabouts for Q4.
So that would include your JLG, IF and RA both included, right? Less than 100 crores?
Yes. That's at the bank level.
Yeah, bank level. Okay, fair enough. And any state-wise, any material development you would like to highlight? Any state-wise in terms of whether improvement in performance or anything like that?
Across the board, all the states are really inched up, including Karnataka. So when we say 99.3 inching towards 99.5, across the board, I think it is closer to 99.5 with no operation of any state being substantially higher or any state being less than 99%.
Okay, great. That's good to hear. So my third question is with respect to recoveries. So this quarter around, there has been a sharp drop quarter on quarter. So could you help us understand the factors behind this trend and how should we think about recovery performance going forward?
Which recovery?
Which recovery?
Recoveries and upgradations from the GNPA. I think it is only 8 crores this time around.
One, the book is shrinking, the book as the percentage of customers which are collecting is going higher. Earlier, the pool was largely large accretion, which meant that the upgrades from the recently slipped pool are higher. Since the slippages themselves are coming down, the upgrades are marginally coming down. However, our entire focus is to go back and revisit the entire thing. We're adding a lot more collection people now that there's huge stability which has come in. There is no big slippages happening from the current bucket to various other buckets. The good news is that because of that, our 1 to 30 collection and 31 to 60 have gone up by at least 10% as a percentage of the slippages. So hopefully at this rate, I think more than 8 or around from 8 crores. Likely that in Q4 it will be closer to around 11 to 12 crores across the cohorts, which includes ARC, our write-off, as well as our NPA book.
Yeah, because the reason I was surprised was that there was a sharp drop from 26 crores in second quarter to around 8 crores in this quarter. So I thought I would just take some clarity over that.
Yeah. See, Shailesh, any recovery out of ARC does not really get reflected here. And also any recoveries out of the write-offs goes towards the income rather than coming towards the upgrades and recoveries here.
Okay, fair enough. The last question from my side. Could you highlight some of the key developments and early traction in our credit on UPI offering in partnership with Paytm? Any key business developments you would like to highlight?
There has been a large scale up which is happening. Approximately around 1.5 lakh customers is what we are acquiring. The activation usually takes the lag of around 2 to 3 months. The portfolio outstanding, though small, is kind of inching up by around closer to doubling almost every month. 15 becoming 30 likely to become around closer to 50 to 60. There's one large cohort of customer, granular, and the average ticket size is currently still less than around about 10,000. The number of customer-wise acquiring is around closer to 1.5 lakhs per month. And we think that by this year and by March, probably around closer to 10 lakh customers would have been approved, of which utilization would be around closer to around 2 lakhs, 3 lakh customers.
What would be your AUM, sir, currently?
Very small, it around 30 crores.
Okay, fair enough. Thanks a lot, sir. That's all from my side and best of luck.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. Thank you. The next question is from the line of Rahul Kumar from Vaikarya Fund. Please go ahead.
Yeah, hi. Sir, can you split the slippages in between MFI and non-MFI for this quarter?
Yeah, so around 105 crores was MFI, and the balance is in the retail asset business.
Okay, so this is the gross slippage which you are saying 105 crores.
Yes.
Okay. And what are the monthly trends in these slippages now versus what it was?
It used to be 60 crores at the beginning of Q1, moved to around 30. Likely that we will see around closer to 25 Jan, and hopefully if the trend continues, the target is to have less than 20 crores, which is used to be what before the entire mini crisis started. So I think we should be back to 20 and probably a little lesser in the month of March. But the trend currently likely to be around closer to 27 crores for Jan, and probably lesser than 25. And if the trend continues, it will be less than 20, around 20 in the month of March.
Okay. Thank you. Second question, if I look at the slippages in the non-MFI segment, I think quarter on quarter I see a 40% kind of a jump. What is driving this?
Okay. So, just to clarify one correction. So, of the 155 crores of slippages that we have in Q3, the split is 116 crores in MFI and 39 crores in the retail asset business. So, if you look at the retail asset business, on a quarter-on-quarter basis, it's moved from 36 crores in Q2 to 39 crores in Q3. We have had a few slippages in our lab business, which we are trying to resolve and regularize before the end of the year.
Okay. Got it. And correct me if I'm wrong. I think you mentioned the target for Q4 slippages is below 100 crores, and this is for the overall book.
Yes, 100 crores for the bank as a whole.
Okay. And what would be the split in that between this JLG and non-JLG?
So, so for IF as a whole, it will be around 75 to 80 and around 20 odd crores or little less for the retail asset business.
Okay. And the last question which I have is, if I look at our credit cost for this quarter, it's I think 41 crores versus 40 crores in the quarter two.
Correct.
Despite our slippages actually reducing from 155 crores to 200 crores to 155 crores.
Yeah, actually, in Q2, we had about 24 odd crores of write back after we received the CGFMU claim, right? So that was a one-off for Q2, which you will need to keep in mind to check the movement.
Oh, okay. Got it. Understood. And another thing you mentioned was the non-MFI slippages will also reduce going forward from 40 crores in the last quarter to less than 20 crores in the Q4. So, right. What is driving that?
There is one large instance of 5 crore plus account in LAP which slipped on a temporary basis, so that created aberration. CV, there was a marginal reduction in terms of recovery, which is back in the last quarter towards the end. So that trend would continue. So given that, we are kind of projecting this, and overall MFI likely to be around shade less than 75, max 80, and the remaining around 20 to 25, max would be from the retail assets. There was a little bit of a slippage higher in the micro mortgage segment, but primarily due to Karnataka, which is back. 50% of the 4% GNP and the micro mortgages are paying book. That's month on month they're paying, but still continue to be in NPA, and which we may not proceed really under Surface C, and they will get regularized over a period of time, which is not likely to be there for the quarter four.
Okay. So, to summarize it, the micro lab issue which was plaguing in Karnataka is driving this, resolution in that is driving this reduction in the non-MFI slippages.
The slippage has stopped and the recovery has marginally kicked up. A good thing is that 50% of the 4% GNPA in the micro mortgages book, which were approximately around 550 crores, is paying book. That's month on month they pay one installment, but probably still have an outstanding of around 2 or 3 installments. So we are reasonably hopeful that it will get normalized to regular over at least 1 or 2 quarters.
Okay. So what are the monthly trends over here in the non-MFI slippages over, let's say, last few months?
7 to 8 crores per month.
Sorry?
Which is what I'm saying. It will be 7 crores, 6 to 7, max 8 in any of the months. This is what you're saying, that the multiplied even at the same run rate, it will be around closer to 20 crores for Q4. Gross slippages.
Okay. Okay. And what was it in the last quarter? I mean, let's say November or December?
December around 8 to 9 crores. 10 crores.
Okay. 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 Thank you. I'll join that with you.
Thank you.
Thank you. The next question is from the line of Arvind from Capital Land. Please go ahead.
Yeah, I have a couple of questions. The first is on the CGFME claims. Now that we have a good timeline of the slippages and some idea about the slippages month on month this quarter, when do we expect to make that claim next financial year? That is my first question. And the second question is on the cost of funds. While the industry has shown a more significant drop quarter on quarter of about 25-30 basis points, we have only had improvement of about 10 bips. So, in spite of the very healthy growth in CASA quarter on quarter, so how do we see it going forward?
On the CGFMU, multiple cohorts for next year, 3. So we will time it out in terms of first and second and probably even third quarter. But the largest chunk would be claimed in the Q1, which may be around closer to 200 to 300 crores. The rest of it would be timed for Q2 and Q3. As far as the cost reduction, over to Casey.
Yes, so, up until this quarter, given the kind of growth in the long tenor retail asset book, we have been trying to raise quite a bit of 5-year money, which today is about 1/3 of our overall deposit book, right? And which is the reason why you don't see a significant drop in our rates on a quarter-on-quarter basis, even though in time deposits across tenors, we have, dropped rates anywhere between 25 to 50 bips. Even our savings account for the lowest bracket, we have reduced rates. So at a point in time, we will move to raising money on the shorter tenors in a slightly larger proportion, and that will reflect the reduction in our cost of funds over time.
And given that we are sitting on a very healthy sort of a rate to deposit ratio compared to the peers, do you expect to sort of reduce the cost of SA in particular going forward to kind of optimize the NIMs?
See, we are actually reviewing it every month. And for example, in Q3, in all the 3 months of Q3, we have gone ahead with reductions in our TD rates across buckets and somewhat in SA as well, especially, the larger ticket SAs, which for us was not making economic sense anymore. And we have indeed moved away from quite a bit of large ticket SA business. So that optimization will continue. The rates will not see a very sharp drop on a quarter-on-quarter basis, but it will continue to reduce over the next couple of quarters.
Consciously, we are focusing that at least a reasonably significant portion of our deposit, specifically linked to the mortgage financing, will be from 5-year deposits. So entire last quarter, we continue to pay a marginally higher rate on the 5-year consciously, and that's why there has not been a substantial reduction in terms of 30-40 basis points. But if we choose to really turn that and in terms of start focusing on the short end of the deposits, the overall cost may come down. But given that our margin interest overall has come down, our focus is to have at least a 20 to 30% of our overall term deposit base in the range of 5-year plus.
Okay, got it. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Jaspreet from VA Capital. Please go ahead.
Good morning. Am I audible?
Good morning. Yes, you're audible.
Yes, sir.
Bhaskar sir, good morning. Bhaskar sir, good morning. I had been observing your bank for the last 5 years, and you were very prescient in taking CGFMU. The IPO timing was perfect, and then moving out of JLG was a very good move ahead of the industry. But somewhere I feel that operationally things are lagging behind. I don't know, maybe it is management bandwidth or lack of talent or whatever. I don't understand that, because things are not flowing into the numbers yet. And this is what I want to understand, what is happening. Are we lacking somewhere in the management bandwidth?
Good question. So I will put it this way. Banking, I think, is a little long haul journey. They're pretty clear even when we really started. This precisely also gets reflected in our taking a hit in terms of PBT, which is by closer to even 25 to 30%. By going for a cover of CGFMU, when the projected credit losses are not more than 1%, and absolutely 99.6, 99.7% collection at that point of time. So we're clearly conscious of the fact direction setting generally takes a iteration and a reiteration. Fairly confident that I think what we went through in the last 2 years, as you would see, the management bandwidth has kind of stayed on, which is through the course. We've seen the up and then one down, and then as we're recovering, we're very, very clear that we are not really almost an assumption the future may be worse than the past. We are kind of put our guardrails, which reflects in terms of a little reduced profitability, in terms of maintaining an excess liquidity, in terms of maintaining higher than required, substantially higher than required capital adequacy. But all of it, when what we really kind of are confident now, and hopefully will play out quarter on quarter in the substantial quarters in the future, is that have the foundation strong in terms of, for instance, moving to a JLG to individual. It is not press of a button and say all of us will do individual. MSME, first round was not a success, what we called as the T-Nagar loans. We paused, we didn't kind of knock off the product, and when digital railings are very strong, now we have around closer to 110 crore book with PAR of less than around 1.5%. I think all of this now it is time for us as a bank to put all of this in action in terms of, as we would call it, strategic hidden strength to play out, and fairly confident that with management substantially in place for the last, we have kind of recruited in the last 1 year. It took around 3 years for a complete alignment. I think it is not the superstars who create great performances, it is aligned management team, and fairly confident rather than just hopeful, fairly confident that this will play out as you would see. In quarter on quarter it will be steady, but every quarter planning that is better than the previous quarter.
I think in the previous quarter also somebody mentioned, I think Himadri mentioned that the next 2 quarters, and then there would be a decline in credit costs, which will add another 50 crores to the PAT. So I don't know, projections are not right, or I don't know what is not coming together to give confidence in the numbers.
No, it will. I think as you would see the slippages have come down. For instance, in the slippages we can kind of provide only 20% of the total recovery, but we provide up the entire 23%. So kind of take, as it really required, 76% is covered by CGFMU, remaining 23%. You have a choice of even provisioning only 10% and pay for it. We said we'll have to take it. We take it on quarter. So with a good, fundamentally, if you look at it, I would rather leave the financial number which is emanating out of it. The slippages from 60 has become, say, 40, 35. 35 is now closer to around 25. Hopefully, we're not saying it becomes zero, but around 20, it's back to where we really started and continue to focus in terms of reducing at least by 1 crore every time. And the CGFMU is the time-lagged one. So it took around 2 years for the first claim, and thereafter, the way in which probably it is projected now, our claims will be substantially higher than the slippages that will happen for FY27 in the IF book. You will see it playing. I would put it that this quarter, fundamentally, with the way we are looking at internally, is far, far stronger than the previous quarter, not just by the bottom line numbers which is emanating out of it, but reduced other income in terms of PSLC, reduced slippages, increased the business momentum, and the clarity in terms of what the slippages will be.
So exactly, I'm talking about this clarity in predictions of.
Sorry to interrupt,
yeah.
sir. We would request you to please join the queue
Okay.
for follow-up questions.
Thank you.
Thank you.
Thank you.
The next question is from the line of Amber from Senia Capital Management. Please go ahead.
Yes, hi. My questions are actually around CGFMU, but on a broader level, I would like to basically carry forward with the previous questioner's comments that every quarter we get this feel-good message from the management that in the next quarter things will be okay, we are on the right path, everything is fine. But I think it's taken a lot longer than the market can bear. So I would like to really get some honest commentary from the management on, because this reduces credibility. If we keep hearing quarter after quarter that in the next quarter it will be okay, but then we still come up with a really, very ordinary set of numbers, then there is I think more introspection needs to happen. But anyway, let me get to the question. My question is for CGFMU, for this 467 crores, which is expected to be claimed, approximately how much premium would have been spent by the bank?
250 crores.
Sorry, how much?
250 approx. Cumulative. For all these
cumulative
years.
250 crores.
Yeah.
Premium. Okay, so roughly 45, 46 paisa for a rupee of claims, right?
No, this also includes claims which have already been made by us. So we had a claim of about 340 crores in Q2. We had a 70 crore claim prior to that and 30 crores last year. So the 250 crore that Bhaskar talked about is the cumulative premium that we have paid ever since we subscribed to the program since FY22.
Okay. So on a basis of paisa per rupee insured, we are still talking around the 25 paisa, 24 paisa to the rupee of insured, right?
Yeah, correct.
Okay. And what is the expected timeline for the actual cash coming in? I think it was 18 months, if I'm not wrong, right?
For a new cohort, yes. But for example, we now have 3 cohorts running because we have been subscribing to this program for 3 years. So our next expected claim is in Q1 of FY27.
Q1 of FY27, which is in about maximum 6 months. Okay. And then my second question is for CGFMU, suppose you guys make a claim and the claim is paid out and then the underlying loans, because I'm guessing you're still trying to recover them, the underlying loans come good. Then what happens? Do you have to give part of this money back or what happens then?
In the same proportion. So 3/4 of the money goes back to the credit guarantee fund and 1/4 of the money is retained by us and is a credit to the PNL.
So on a defaulted loan, you can only cover maximum 3/4, and if it comes back, then you have to give 3/4 back. Is that the logic?
Of course.
Yeah.
Okay, understood. All right, that's it from me. I wish you the best of luck.
Yeah, your inputs are taken. Surely we'll do it. There are certain things as an organization, for instance, our ticket size, if you choose to really marginally inch it up, even by 20% instead of around 75,000 in IF, profitability will do really kick in. So as a bank, which we still think that we are young at 9 years, just completing today and entering the 10th year, some of the mechanisms, including say tech, whatever we put, it took time to really play out. And when Credit on UPI really scales this way, so some of this gets rectified. But the only input which we sincerely take is in terms of too long is not too good. So thank you very much for your frank input. Thank you.
Okay, well, thank you and all the best.
Thank you. The next question is from the line of Vatsal from Astral Mind Capital. Please go ahead.
My question was around the fundraise which you are planning to do. So is it still like you'll be obviously raising the fund below book value, which will be like, and you are raising around 1,000 crores, so it will dilute the shareholders by like around 40%, right? So have you thought about why this fundraise is needed and like the timing? Have you like explored other opportunities of why where you can raise the fund?
Ideally, there should be an enabling resolution taken on a continuous basis. There is no intent for us to raise money at this current price. We don't really require. We've always been, as you would see, it is not just about the last year. Right from our inception as a microfinance company, we believed that as long as our unsecured is substantially higher, even at closer to 45-50%, capital adequacy should be more than 20%, irrespective of what the regulator requirement. So we do not really require any capital. That will require will be purely from a point of view of a growth capital. We're making sure that we are about 21-22%, and the timing is not necessarily we need an enabling one to keep. Otherwise, it takes around a month and a half too. And this is purely enabling. No intent to raise money, anything at this price in the immediate run at all. We still have a large amount for tier 2 capital ever we require it on an instant basis.
And also, like, we have grown as an institution, but that has clearly not reflected in the shareholder wealth that has been created. So, is the management aligned towards creating shareholder wealth, or like, I want to understand what is your perspective on this?
I mean, the answer obviously is going to be in the affirmative. But that said, I think the previous two speakers also have given what it takes. So fundamentally, when you do some things on a long haul basis, it does not necessarily reflect on an immediate basis. But the inputs taken, certainly I think I would say that more than giving a feel-good feeling, fairly confident as we step on into it. The last 2 years was in terms of the more getting out of the whole thing unscathed, and which fortunately we've been able to do it. While we will not be making any comments in terms of how the whole thing played out, for us it is looking stronger fundamentally, and that's one thing which we as a management team will need to look at, is that while all stakeholders, the one stakeholder where we have not really did justice in the last 5 years specifically has been in terms of shareholders. Not that we'll work anything specific only towards that, but I think good growth fundamentally strong, and hopefully to hear from all of you that we did really do the job which we have been interested with by the shareholders.
Okay, all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Vedant from Artha Energy Group. Please go ahead.
Hi. I actually have a follow-up, and my questions are related to the ROE itself and the QIP, along with the shareholder wealth that the lack of which is being created. So I just wanted to understand the management's strategy to improve ROE and the steps that they have to take in place, especially since we have a QIP coming up, maybe near term or future term.
As I said, the capital raise is an enabling provision, so we're not going to dilute anything at the cost of our shareholders. So whenever an opportunity comes, and we'll be right in place, and we always raise money much ahead of our requirements, so it's pure enabling. So to that extent, the other thing would be hypothetical. In terms of ROE, we said that will be run rate will be closer to around 11% in Q4, 10% above, and probably closer to 11. And first, let's achieve that, and I think at the end of Q4, when we give a guidance, we really look forward to giving more meaningful and robust one, which is achievable. One learning out of that, every time you give a projection in a very, very volatile market like what it was last year, you project something and it doesn't really play out. Certainly for last year, one which we didn't really play out to the way we wanted is the slippages. It was looking like normalized, but it kept on happening. But hopefully it will reflect in terms of our recovery back. It's fairly clear that while we get a CGF from recover, our intent is to return back as much as possible, just as it were our own credit losses. So while 25% will come to us, I think that's what we will see, which will fundamentally, I think, not move the ROE needle to upwards of around 11%. But that is, as we see, Q4 is where it is pretty clear. Once we have done that, I think far more clarity in terms of what is to guide for FY27. So give us some time till one more quarter for us to commit in terms of what the steady state would be, at least in terms of 27 and 28.
Got it. All right. Thank you.
Thank you.
Thank you. The next question is from the line of Rahul from Bulgaria Fund. Please go ahead.
Yeah, hi. Can you tell us about the NIM trajectory over the next couple of quarters?
So, I think from where we stand today, we expect the NIMs to be around 7.5% to 8%. As we have seen, our paying book has increased in this quarter, and we see that trend be continuing in Q4 as well.
Okay. And how have our yields on the paying book moved, in this quarter?
So, one thing that we need to be cognizant of is that, in our individual loan book, we did a repricing somewhere around July, August last year, and that higher price 28% book is running off and getting replaced by the book at current pricing of 26. So even though the paying book is increasing, there's a rate impact associated with it. At current levels, yields are around 17.5, and also given the fact that the share of retail asset is slowly inching up, we would like to see that there's not a big compression in the yields from where we are today.
Okay. And have you sort of increased the yield for the on the disbursements in MFI segments?
No, not at this particular point in time. We are constantly evaluating whether there is a need for increase in pricing across risk bands, but at this particular point in time, we have not raised our rates in these 9 months.
Okay. And in terms of AUM mix between MFI and non-MFI, I think currently we are at 45%. So let's say over the next 2-3 quarters, what kind of mix we are seeing and what kind of growth in MFI we are seeing now?
So I think the number will go up a little bit once, we do a write-off and then, the paying book comes in. There is also our new products, which will kick in. So the retail asset book will continue to be a little over 50%, but MFI will also improve a little bit from the current 45.
Okay. And I think you mentioned that you'll be doing a claim in Q1 and you have 3 cohorts running. So in the Q1 claim, out of this 465, how much would be the claim amount?
I would say somewhere closer to 400 crores, 350 to 400.
Okay. And this is for the loans which were disbursed in 2024?
Correct.
Okay. And if I look at the labor code impact for you, I think it's pretty low compared to if I see the comparison to the peer group in this industry.
Right.
So can you just help us understand that?
Yeah. So even in our current salary structure, the basic pay, or what is being called wage in the new definition, is closer to 48%, right? So we are actually very closer to the 50% threshold that the new law speaks of. So, and as a result, the impact for us has been quite modest. If we were to really, reach that 50% number, we would possibly need to have an impact of not more than 6 to 7 lakhs of compensation per month, right? So that's just about the impact we are likely to see.
Okay. And in terms of overall OPEX, if we look at next few quarters, what kind of OPEX growth which we are targeting?
So, like I said a while ago, with the increasing share of the paying book, we would like to see that our CTI goes below 65%. Currently, the CTI is a little elevated because I'm still carrying almost 800 crores of non-paying book, right? Once that is replaced, then, and the paying book increases, I will see a natural improvement in my cost-to-income ratio. And currently, we are looking to reach that 65% as a first port of call.
Okay. So this is the exit for next year, which you're targeting.
Yeah.
Okay. Got it.
We didn't want to give any projections for FY27. Thanks.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Chinmay from TCN Capital. Please go ahead.
Hi, good morning, sir. So my question is that could you give some color on the recovery rates in the 30 to 90 book? So basically it's at 1.9% at the moment. How much of this do you see flowing into the NPA bucket, and how much of it could be recovered? Some sense around the flow rates, basically.
Not very clear. Were you able to hear it?
So you want to understand 30 to 90 recovery rate and what is the expected flow from 30 to 90?
Yes.
Okay. We have improved significantly on the SMA buckets collections recovery. Now we are hitting at 55 to 60% on 31 to 90 bucket on MFI side. And on retail, we are completely intact. Nearly 90% of the portfolio gets collected. So the flow rate is minuscule on retail, though it looks elevated on SMA bucket. However, it doesn't flow much. And there is another segment within retail, our partners, which is lending card, MobiKwik. There the flow is higher. Flow is 40 to 45% on the 30 to 90 bucket. That's a smaller portfolio on retail assets.
Maybe 100 per portfolio.
Yeah, but the key takeaway is, SMA buckets, especially in the MFI business, our collection efficiencies have improved significantly, and that's largely on account of all the efforts that the team has put in. I mean, just as an example, in the 30 to 60 bucket, the collection efficiencies have moved from 40 to 50 plus. So, and that trend continues.
Got it. And secondly, I just wanted to confirm that the medium-term credit cost guidance is around 1%, right? But is there a sharp improvement expected on a quarterly basis in the coming quarters when the slippages return to the normalized level, or is that something a little out in the future?
Out of the future, I think we're very happy. The good thing is that we're real kind of without any other things. So 60 becoming 30, becoming closer to 25. I think we'll take this quarter as a real very key thing in terms of really seeing what it is, not just in terms of increased efforts around resulting in results. Overall portfolio, the fundamental quality of the portfolio has increased substantially, specific in terms of IF, closer to around 99 points. I think the GNPA emanating out of the last 1 year generated portfolio in IF is less than probably around 0.2, 0.3. The intent is to really see it, including which is more than 10 months MOB. Where is it going to be? Can it stabilize at around 0.3? I think we'll have far more clarity to kind of give future projections in the end of the one quarter, because the whole thing is to see whether the trend which is declining in terms of delinquency continues and stays at 20, which is what we used to be. I think that's the first port of call. I think once we reach there, we'll get kind of enough of clarity for us to tell with confidence. Otherwise, it becomes like almost crystal gazing.
Sure, sir. Got it. Thank you.
Thank you. The next question is from the line of Avnish Tiwari from Vaikarya Capital. Please go ahead.
Hi. Most of my questions have been answered. Can you articulate your growth in MFI paying book, how it moved, let's say, in Q3, September versus December, and how do you see with the current disbursement rate it moving in Q4?
It is back to what it was. It kind of declined. I think it was around closer to 5,000 crores, kept going down to around 4,344. So ask Casey to kind of elaborate it.
Yeah, so on a Q-on-Q basis, our paying book has increased by around 180 crores. And given the collection efficiencies that we have in, especially in the current bucket, we expect that trend of the increase in the paying book to continue.
And what was the paying book by end of, let's say, December 2025, and how much of the typical repayments you are getting from your paying book?
Like we said, in the bucket 0 for MFI business, our collection efficiency is around 99.4. So that's the kind of flow rates we have. And we are quite confident that we will be able to reach, 99.5 by Jan-Feb. So which means that we will have a flow rate of not more than 0.5%.
Okay, so one can take a 0.5% flow rate from the paying book. That is
current book. Yeah, yes.
Current book.
Correct.
But there will be some natural repayments also, right? The loans getting completed. Because you have 500 crores of disbursement, and these two number one can subtract to get an increase in paying book, right? So what is the normal rate of repayments, which like normal loans closure or normal payment fees from paying?
Yeah. So you will see that on an average, the paying book will increase by around 120 crores in IF in a month.
Okay. And the Vikas loan?
No, IF includes Vikas loan. So if you look at the bank as a whole, my paying book will increase by around between 250 to 300 crores in a month.
Got it. As a bank as a whole, right?
Yes, bank as a whole.
And around 120 you said, or 180, which number you said for the IF book?
About anywhere between 100 to 120 crores per month for MFI.
Got it. Understood. Thank you, and wish you very good.
Yep.
Thank you. The next question is from the line of Swaraj Dev, an individual investor. Please go ahead.
Hi, sir. Good afternoon, and thank you for the question. Am I audible?
Yes.
Yes. Sir, most of my questions have been answered. I just want a qualitative feedback from your end with respect to asset quality and our ROA guidance also. So basically, if you look at it, we have been giving an ROA guidance we have revised our ROA guidance twice right now. I've been following for the past couple of quarters. And right now, it's at 1.1. And even gross NPA, we are sticking to less than 5% and net NPA less than 3%. So taking everything into consideration, I understand internal targets for the sales team could be different and would be higher. But however, for the investors of your bank, what do you feel is a realistic figure that we can achieve by Q4 of this year, sir?
See, I think where we're probably not able to clearly kind of codify is that where there is an increase in the GNPA and NPA, the impact on either the capital or in terms of our P&L will be very close to zero after having provided. For the one at the end of the last year, when our projections are not even end of the last year, it's about December of 2025 or 24. It looked like the slippages were coming down, but didn't happen in the first quarter. That I think was an impact that we are carrying in terms of a higher GNP of 6.6 or a net NP of around 4.3. Since we don't write off, and as Casey explained, so that whatever gross flow or net flow which happens will reflect in our GNPA, because we cannot write off whatever is claimable under CGFMU till we get the payment. Otherwise, they'll have a choice to do that on a normal basis. So that timing, hopefully, as I said, in next year onwards, the claim will be substantially larger than the net slippages that will happen, and we intend having that. And in fact, it will even come to a point where the premium that we pay will maybe higher than the claims that we'll be making in the cohort. This was not taken from a perspective in terms of multiples of premium that we'll collect. This was to protect ourselves in an event like this, which we didn't obviously forecast will happen in 2 years' time. So that will in respect of that, will continue to be covering our entire eligible CGFMU under the CGFMU cohort. So the slippages will be lower, and yes, our guidance on that went down, and that had an impact in terms of our ROA guidance itself. It was from a business point of view, while the disbursement everything was higher than what we projected. The slippages did take a toll in terms of P&L, consequently in terms of the GNPA and ROA, and also in terms of our cost to income. I would say that Q4, as we kind of guided, is around closer to 1.1% on the lower end, and ROE of around 10 is the first thing that we would like to achieve before we really project for the subsequent quarters.
Yes, sir. Thank you. And I just wanted to understand how confident are we internally on this ROE 10% and ROE 1.1% by Q4?
Give us time, and hopefully we'll be able to get better it, and we'll obviously we're confident that we will report, but this is purely in terms of what we saw in Q2 and Q3, and this trend should continue because across the industry also there has been huge stability, not just us seeing it, and we'll be pretty confident of going towards 10 and ROA of around closer to 1.1.
Okay, sir. Thank you. That would be it from my end. All the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. And I now hand over the conference to management for closing comments.
Thank you very much, and your valuable inputs are taken in the right spirit, and hopefully we as a bank will make all our stakeholders proud by doing things fundamentally strong and as well as making sure that we're keeping up to all the guidance that we give. Thank you very much.
Thank you. On behalf of Arihant Capital Markets Limited, that concludes this conference. Thank you for joining us, and now you may disconnect your lines.